A 1.1 million square foot warehouse in Fort Worth, Texas is stockpiling goods ahead of expected tariffs on imports from China, Mexico, and Canada. The U.S. economy heavily relies on imports, particularly from Southeast Asia and China. Anticipating higher costs, companies like Walmart and Columbia Sportswear have ramped up imports. Walmart's from China surged 33% in 2024, while Columbia Sportswear saw an 80% rise between March and December. This strategy, known as front-loading, helps businesses avoid steep tariffs, but smaller importers struggle with the uncertainty. Former President Trump proposed a 25% tariff on Mexico and Canada starting February 1st, alongside a 10% tariff on China. Tariffs act as taxes on imports, ultimately raising prices for businesses and consumers alike, affecting essentials from cars and electronics to food items like avocados and tomatoes. InfoFusion visited Fort Worth, a key logistics hub, to examine how companies are navigating these changes. Paul Brazier, head of global supply chain for its logistics, explained that Dallas-Fort Worth services 75% of the U.S. within 2 days, handling electronics, food, and infrastructure components. To avoid tariffs, many ITS clients have been front-loading since late 2024. Lenovo's China imports, for instance, rose 22% from 2023 to 2024. Infrastructure projects, relying heavily on Chinese materials, have been particularly affected, as budgets set years in advance cannot easily absorb sudden cost hikes. Import Genius data shows a surge in imports of solar panels, AI servers, lithium batteries, and consumer goods like apparel and fire pits. However, warehouse storage is expensive, disproportionately affecting smaller importers. Large retailers like Walmart can leverage vast distribution networks, but smaller companies like Deer Stags, a family-owned footwear brand, lack such resources. Footwear imports already face high tariffs, some dating back to the 1930s, with additional duties pushing costs even higher. For businesses like Deer Stags, surprise tariffs on goods already en route could create financial strain and logistical nightmares. The tariff battle extends beyond China. Mexico, the U.S. largest trading partner, accounted for $466 billion in imports in 2024. A 25% tariff could disrupt supply chains, increase costs, and lead to job losses, particularly in the automotive sector, which exports 76% of its 3.5 million vehicles to the U.S.-Canada. A crucial supplier of oil, minerals, and chlorine for drinking water could also be affected. Retaliation from China, Mexico, and Europe looms as a major risk. Mexican officials have warned of countermeasures that could impact U.S. businesses operating in Mexico. Economists estimate tariffs could shrink Mexico's GDP by 1.7% over 5 years while increasing inflation by 2.3%. As global trade tensions rise, the ultimate burden falls on consumers, with businesses passing on higher costs through increased prices.